So here are some of the quick guideposts for the tax deferral. The ESOP needs to buy 30% or more of the stock of a regular privately held C corporation, not an S corporation. Seller must be an individual, not a C corporation. S corp, regular individual. Seller needs to reinvest the money within 12 months. There's a like-kind exchange rule. It's a little bit like if you have a piece of land and you sell it for a gain, you can defer your tax on your gain if you reinvest into other stock or bond, other real property, of similar like-kind property. So the same thing here is true, although here we only have 12 months for reinvestment, not 18 like you have for a like-kind exchange, 1031. Funds must be reinvested in qualified securities. We'll talk about sellers need to aggregate into one sale. Sellers can aggregate into one sale. So if Gary and I are selling, say each Gary and I are 50-50 in the company. If he sells 15, I sell 15. Together we have ESOP owning 30. Together we get tax deferral. Tax deferral continues only as long as the seller continues to hold qualified property. So if and when you sell whatever you buy with the money, that triggers capital gain. So what would be stocks or bonds of other companies that would qualify for the long-term security? I've got stock of a private company. I can sell 30%, take the money out, reinvest into other stocks or bonds of other companies, and defer my capital gain tax. So what are like-kind securities? Well, they're public or private, stocks or bonds, existing corporations or new corporations. You've got stock of a successful private company. You can buy other stocks or bonds of public or private U.S. corporations. And a lot of our clients use this opportunity to really build a portfolio of investment-grade blue-chip securities, Warren Buffett kind of securities. Now, it can be a brother-sister corporation, but not a subsidiary of another ESOP company. So if Gary and I are 50-50 in this company, and we're also 50-50 in a separate corporation over here, the two corporations are separate, but because the same people own the two in the same percentages, they're deemed to be brother-sister corporations from a tax standpoint. You've got to buy other companies, stocks or bonds, and it turns out that a brother-sister corporation would qualify as an investable, a good investment. Non-qualified investments, passive income, 25% of gross revenue a year prior to the purchase. So this is, let's just say that you love Procter & Gamble is your favorite security in the country. It's the biggest consumer goods company out there. Is Procter & Gamble a sufficiently active company to meet our like-kind exchange rules? And the test is passive income, rents, royalties, and dividends. What percent of Procter & Gamble would be rents, royalties, dividends? About 5% of the total revenues. So 95% would be coming from detergents and toothpaste and selling other products like that. So P&G would easily qualify. How about Procter & Gamble? What percent of their total net assets are used in the conduct of business? Well over half the assets. So P&G would easily qualify. You might say, Bruce, Procter & Gamble is a great company, but I don't want to buy just one company called Procter & Gamble. I want to diversify. Well, you can't buy a mutual fund, even if it's itself buying individual securities, because the fund itself is not like-kind property. So what you could do is you could create your own informal mutual fund. You could say, okay, take out my $3 million, and I'll buy $300,000 of Procter & Gamble, but $300,000 of Google, $300,000 of IBM, so you can diversify across a whole host of securities. In this, you have 12 months, you sell to the ESOP, you've got 12 months to make your reinvestment into one or more securities. Stocks or bonds of other companies, not REITs or not government securities. Now, if you want to go into the long-term, if you want to go into bonds, stocks or bonds, you might say the stock market's too volatile, it's too frothy. Who knows where it's going to go in 5 years, let alone 10 or 15 years. What you could do is you could buy long-term bonds. Now, if you buy a 2-year bond with your money, when that bond matures, that's deemed to be a sale taxable event. So if you want to get the most miles out of a long-term bond, make sure it's a long-term bond. Because remember, the tax deferral continues only as long as you hold the security that you buy. And if you ever were to sell securities before they went into your estate, you'd have a capital gain deferral that would be stopping. So buy long-term securities, and you could buy 20-year long-term bonds and make sure they're not non-callable bonds. You can buy floating rate instruments, which gives you interest rate protection. If any qualified property is sold, prorated tax becomes due. So what's an approach? You could buy a long-term floating rate note. These are long-term bonds with a portfolio that can be actively managed without triggering into the tax deferral. So you want to develop a portfolio of assets, stocks and bonds of other companies that give you the income you need, gives you the risk profile that's acceptable to you, and it will generate long-term deferral. So here's an idea. You could buy a long-term bond, and there are companies that issue these long-term bonds, like the JP Morgan Chase, for instance, issues a 40-year long-term bond. Now, if you sell the bond during your lifetime, taxable event, not such a good deal from a tax perspective. But if you buy a 40-year bond, let's just say you're 50 years old, you buy a 40-year bond. If you don't live to be 90 years old, then at your death, the bond has a step-up in basis, which means that you pay death tax, your heirs pay death tax at the full value of the bond at the maturity, but the entire capital gain is forgiven, step-up in basis. And you could say, well, you know, we have step-up in basis already with our securities. By the way, if you guys all take off, I'm going to still do the seminar, so. So the point is that during your lifetime, while it's still fun, you can buy a long-term bond, you could borrow against it. With the borrowed proceeds, you could have total reinvestment freedom with total other stocks or bonds of other companies, or other net uses of the capital that you have. So sell stock for value, defer capital gain tax, preserve the step-up in basis, so you never do have to pay capital gain tax. And during your lifetime, you can liquidate that with total reinvestment for proceeds if you choose to. A lot of people think that's a great idea. A lot of people think that's too fussy, so it just depends upon each company. Other ways to get cash into the system. So here's a kind of an illustration of using 3 different methods. Go to the bank to borrow the funds. Here, $3 million is an example. Have the company make a one-time company cash contribution. And then if you have a prior profit sharing plan, you can convert prior profit sharing assets. Total assets are $4 million. $4 million is 40% of our company worth $10 million. So this is an example of the ESOP owning less than a controlling interest. Now, if the current shareholders want to maintain control of the corporation, which is the goal of most of our clients, is it important that you keep ESOP below 50%? In this case, it's only 40%. The answer is no, this number could have been 50.1, this number could have been 100%, and control could have been maintained by the current shareholders. You may not want to sell over 40%, or maybe the company can't afford to fund more than 40%. So there are economic reasons to keep ESOP below 50, but there's no reason from a control kind of preservation perspective to keep ESOP below 50%. Minority shareholder, what can the ESOP do to the minority shareholder? Here we assume a 23% long-term capital gain tax rate. The bank comes in for $2.5 million, because remember we have a 25% owner with a $10 million fair market value. Okay, so $2.5 million is our bank financing transaction. Because the ESOP owns less than 30%, it only owns, in this case, 25%. That's all the minority shareholders are selling at the time. Cap gains have to be paid. So $575 is lost to the selling shareholder in long-term capital gain taxes. But ESOP, the employees, though, got a good bargain. They got a good ESOP investment for 25% of the company. And we assume that the majority shareholder at no personal cost now votes the full 100%. So there's a control maintenance, if you will, or control consolidation by the non-selling majority shareholder. Now, what would you do if you were friendly? If you're the majority shareholder, what would you do to help out your buddy here? Sell 5%. You sell 5, the minority sells 25. Now ESOP owns 30%, and that gets ESOP tax deferral to the selling shareholder if the ESOP owns 30% from one or more shareholders. Or you could do a prorated transaction. Each shareholder can sell into the ESOP in proportion to ownership. So if the 75% shareholder sells 30, it's 22.5. and the 25% shareholder sells 30 or 7.5%. So each shareholder can sell into the ESOP in proportion to ownership. I'd like to increase the ESOP concept up the curve more quickly. Now, there's a couple ways to do it. AFCO, as I said now 3 or 4 times, they had their ESOP buy blocks of stock. I think it was maybe 10 the very first year, then they sold another 25 or 20 to get ESOP at 30% for the rollover. Okay, so you've got, in this particular case, 2 different loans. You've got a bank loan for 5 years. It's going to run through years 1 through 5, and then we're going to interrupt that loan in year 4 to sell half the balance of the stock. So if the company is worth $12.66 million in year 4, half of 12.66 is 6.33. So dollar cost average, we're going to sell stock, get some money off the table today, and then if the company is growing in value in the meantime, then the second half might be worth more than, say, the first half was. The problem is we have 2 loans, $8.33 million loan in the first year of that year 4. Because the first loan's been paid down to $2 million, and then you've got 6.33 new money. So if I were trying to be conservative about this whole thing, I would say let's delay the initial sale and delay the second sale until year 6. Let the first loan fully pay out, and that way we have overlap. We have sequential loans, not overlapping loans in year 4 and 5. Or you could take a look at how an ESOP could work in tandem with a management buyout, and certainly John talked about management succession planning. So here's a case where an ESOP could be purchasing stock, in this case 86%, and then the management would come in, and management would come in for 14%. Now, where did the management get their 14%? It could be through some combination of stock purchase and stock bonus. Stock purchase would be just a direct offering to the key employees, and stock bonus would be performance-based bonuses. Typically you think of cash bonuses, but you could also have a stock bonus for key employees. So the bank, how do we fund the ESOP? We'll pre-fund for a couple of years, bank financing for say 3, seller note for 4.4, the management comes in for their 14%. Okay, so here's a 100% sale to an ESOP without separate management buyout. Without separate management buyout. CRS corporations, but if the company doing an ESOP is an S corporation rather than a regular corporation, and the ESOP owns 100% of the outstanding stock at the outset or in 2 or more stages, then the company is federal income tax free. So if you're an S corporation and the ESOP owns 100% of the stock, either at the get-go or in 2 or more steps, then the company's income tax free. And now most states follow federal income tax law in this regard. So I will, knock on wood, put together 10 new ESOPs this year. And of my 10, 2 of the 10 are cases where the ESOPs can buy 100% of the stock at the get-go to create an income tax-free company day 1. A lot easier to pay off acquisition debt if you're running income tax-free. Now there still are opportunities for key managers to have equity. It's not equity in the sense of stock, but it can be phantom stock or stock appreciation rights, where basically the employees receive any growth. There are a lot of a certain number of shares on paper, not actual shares. And then there's a strike price, the value of the stock when they're granted those SARs. And then if the stock, say, doubles in value over a 10-year period, they can then sell a stock and pocket the capital gain as ordinary income. Okay, S corporation ESOP. ESOP share of S earnings is exempt from related business income tax. So this is why if you have a ESOP-owned S corporation, where the ESOP owns 100% of the stock, would never pay income taxes. Okay, so that's a profound point, and let's say 20% of my clients this year are doing just that. That still leaves 80% of my clients this year that are doing ESOPs that don't purchase 100% to begin with. So it could be very gradual, it doesn't have to be all at once. 100% ESOP-owned S corporation never pays no more income taxes forever. Okay. Potentially significant income tax savings can allow the company to accelerate repayment of the ESOP bank financing or seller note. Yep, that's what's happening. And here, the selling shareholder, Tom, owns all the stock. He's a young 50 years old. S corporation, his comp is $265,000. There are 25 other employees, each making 50 grand on average, so we have $1,250,000 of compensation. Taxable income, $1 million. Company trades for $5 million, 5 times adjusted pre-tax. Now we say that Tom's got compensation of $265,000. The $265,000, if you take a look at all the compensation for all the employees, you've got 25 each, others owning have $1,250,000 in comp, plus the 265, so we've got $1,515,000 in total compensation. So Tom's comp, 265, is 17.5% of the total compensation for all employees. So we'll show how this works. Tom sells stock, takes back a note, so it's seller finance transaction. So Tom accepts a promissory note. Now we need to pay Tom on his note. We're going to do that by the S corporation making a deductible cash contribution to the plan. ESOP takes the cash, it sends the payment to Tom. Usually over a 5 to 10 year period, Tom is fully repaid. That's if it's seller financed. And typically what he'll do is he'll elect installment tax treatment, so as he receives his payments every year, he's paying ordinary income on the interest income he collects. He's paying long-term capital gain tax at the then cap gain rates on the principal he receives on the note. How about if it's bank finance, where a bank like a Capital One would make a loan? Now we know that the banks, from this morning, we know that the banks loan to the corporation and the corporation loans to ESOP. But we just cut that part out because the slide was already pretty busy, so we took a liberty. But basically, the lender loans to company loans to ESOP. ESOP sends the money over here to Tom. So Tom has got cash day one of this transaction. And then we have to pay back the bank. So we say that the S corporation makes tax-deductible contributions to the ESOP. ESOP takes the cash and sends the money over here to repay the bank loan. So it's still a deductible cash contribution by the S corporation, and here's the result. So the S corporation taxpayer pays no more income tax. It's tax deferred, or it's actually tax free since the company is no longer a taxpayer. Tom gets $5 million on the gain, has to pay cap gain tax, not on it's capital gain, not ordinary income. So he is paying capital gain tax. Remember, the tax deferral only applies if you're a C corporation. But if you're an S corporation, then you've got cap gain tax to pay. Is allocated 17.5%. His payroll was 17.5% of the total pool, so he'll pick up 17.5% of the total allocation. So he loses maybe 30% on cap gain, but he picks up, say, 17.5 on his allocation, which he'll be able to cash out when he leaves the company. Since the company avoids making distributions to fund income taxes, now non-existence, additional company cash is available to repeat that and increase company cash flow. All right, and this just shows how if you're an ESOP owning 50%, you don't have to have an ESOP owning 100% of an S corporation to have some income tax savings. Here in this case, ESOP owns 50%, and it gets ordinarily the shareholders have to get their S distributions, and they use it to pay taxes. There's no cash left over because the ESOP is not a taxpayer. The distribution goes right down to the ESOP as equity to the ESOP. So we retain the S corporation despite taxable sales. So there's no tax-free rollover transaction here. Do not convert the S corporation to C corporation prior to the sale to the ESOP. Before the sale of the company stock to the ESOP, the shareholders take a tax-free distribution of 100% of the previously taxed but undistributed S corp earnings. So if you're an S corporation, as you know, you've got taxable income. Some of the money you take out to fund your income taxes, but the balance of your earnings, if you keep them in there, you build up this accumulated adjustment account, or the AAA account, and this money has already been taxed, so it's best that you take the money out as a distribution of tax-free asset. You might take it with a long-term note, but you still take a tax-free distribution. The shareholders cash out of the zero basis equity and pay cap gain tax. If it's bank financed, the sellers pay cap gain tax at the time of their sale. If it's seller financed, then you can either pay tax at the cap gain rates as the sellers receive principal payments, or you could opt out of the installment tax treatment and simply prepay your cap gain tax at the time of your sale. That way, if the rates climb in the meantime, you're protected. Okay, so we're doing a taxable transaction. Because we're paying capital gain tax, if sellers can be in the plan as a participant, there's no requirement for 1042 tax-free rollover. There are no restrictions on, they only apply for tax-free rollover transaction. And the beauty here is we're retaining our S corporation advantages of single tax on income and complete asset sale. Or the alternative would be to do the tax deferral. If you look at your numbers and there's a real big capital gain tax due, you might go ahead and take the AAA out like we talked about before, and then on the zero basis equity or near zero basis equity, defer capital gain tax. So here's the scorecard. If you're S corporation now, if you do an ESOP, you might retain your S election for the advantages we talked about. Or in some cases, if there's a real large capital gain tax, you might consider becoming C corporation doing the tax deferral. Now, if you ever leave the S election, you can't go back to it for 5 full years. So before you leave the S election, on the one hand, you'd be tempted to leave the S election to qualify for the C Corp tax deferral. But if that meant that you didn't have S Corp benefits for the 5-year period, you'd be think long and hard and defer to your tax advisor before you left the S election and couldn't go back to it for 5 full years. Now the financing, let's take a look where we are. So we need to, I think I'll skip a lot of these slides, but basically it's a mature market. For 41 years, ESOPs have been, bank finance transactions have been very active. It's not just the Capital One / Hibernia banks, but a whole variety of other banks that make ESOP loans. Companies get a deduction for the principal and the interest, significantly increasing the amount of cash the company needs to generate to repay a bank loan. If we can write off the principal, it's a lot easier to pay back a bank loan. Let me, and this slide basically says if we need to buy $3 million of stock, if we have to use company after-tax dollars, then that's $5 million of earnings. You pay tax on that as a company. It leaves you $3 million after tax to make your stock buyback. So it takes $5 million of pre-tax earnings to buy back $3 million of stock if you're doing an after-tax transaction. If you're doing a pre-tax ESOP transaction, it only takes $3 million of earnings to buy back $3 million of stock. So let's just skip through these slides. Basically, bank loans and seller financings for that matter, what we're looking at are really the earnings before interest, taxes, depreciation, amortization, so-called EBITDA. This is the metric, a cash flow metric, which is most commonly worked with as a banker. And it's your pre-tax earnings before taxes, plus add back interest, add back depreciation, gives us this EBITDA. And what's the 3-year forecast, 3-year historical EBITDA, 12, 13, 14. And then we take the $1,950,000 as our cash flow from historical operations, throw a coverage ratio in there because the company can't spend all of its cash on debt service, only typically 2/3, which is about a coverage ratio of 1.5. And if you had $1.3 million, you could then use for debt service, and that was your payment over 6 years of 7%, you could debt service $6.2 million. So we want to be able to borrow, using as our annual payment a percentage of our EBITDA, the metric for cash from availability. And so some derivation of that will be the way to look at the financing idea. Enhancing borrowing capacity, seller note for a chunk of it, if not all of it. A lot of our clients just take seller financing on the whole thing. They say, we don't need to deal with the bank. We'll just take the interest, charge a nice 5, 6, 7% interest, and call it good. Pre-fund, sell less shares to begin with, sell non-operating assets, wait a year, anticipate increased cash flow, personal guarantees. So there's seller financing. You've got the traditional seller financing, and then you've got the fully priced seller financing. Traditional seller financing, 10 to 15 year payment without a prepayment penalty, 6 to 8% common pay. That's typically the arrangement you take. Sometimes you go 6 to 10 to 15 years without a prepayment penalty, 6 to 8 current pay. But if you want an internal rate of return of more than 6 to 8% current pay, then you could have warrants to make up the difference for some of that. Okay, I'm hopelessly behind. We'll stop at 4 o'clock here in 15 minutes. So this goes to the softer side of ESOP. You align the interests of the stakeholders so that everybody is motivated to have a higher profit and higher value of the company. So there's a real good case book, a book called the SAIC Solution, which is written by the founder of the SAIC company, big engineering company back in Washington, D.C. That's a great in-depth case study on a scientific company using ESOP. They built a culture rooted in the idea that those who contribute should own it, and ownership should be commensurate with a person's contribution and performance. That's a real good book to think about buying. Now, people work best when they work for themselves. Nobody washes a rental car. Yes. Is there data, objective data, to support the notion that stronger employee performance is a result of higher employee ownership? Well, there have been a number of studies that looked at this. Most, not all, have indicated a good, strong causal relationship, stronger employee ownership, stronger profitability and productivity. And one study in particular was this law firm in Los Angeles, Reich and Luffman. They looked at 600 company respondents, and 93% reported reduced absenteeism, less turnover, greater employee morale. Now, another statistic is back in 2009. Now, this is dated, but the data subsequently is no different materially. Is 91% of the ESOP of the executives said the ESOPs were a good decision to do. 2% said it was a bad decision. So my question is, why did the 2%? What might explain why 2% of the company executives that did ESOPs later regretted the idea? The one potential downside of ESOP here is the notion that if you take on too much debt, whether it's pre-tax or after-tax, it's still cash money due the bank if you do a bank finance transaction. So I think that probably, I don't know the details here, but in my own experience for doing ESOPs for 30 years, is the single biggest trap you want to avoid is making sure you don't over-lever the company. It's bad enough to do with too much seller financing. With seller financing, the seller can always agree to a holiday on the debt service if the company hits an air pocket. But if you're dealing with a bank, there's little, if any, flexibility the bank has in agreeing to a bank holiday. Okay, so make sure you don't over-lever. And I think that employees, the odds are the highest that the employees will respond well if you have a company that's financially healthy, not trivial company contribution, at least 2% of payroll, at least per year, effective ongoing communications challenge. So we're not talking about turning around a troubled company, but if you already have a strong company, the ESOP can make a good company that much better. And this slide really focuses on the two different touch points the employees have. The employees can help the company with their top line, increasing revenues. So if they can increase revenues by 2% while holding expenses flat, that would tie us to a 50% bump in the pre-tax earnings. Now that's if it's focusing just on the top line. You might say, well, Bruce, we have already salespeople that are plenty motivated with commissions. We don't need to have a bunch of employees as owners to be motivated to help increase the company top line. And I think that might be a little bit unfair, but let's just give that point. So the other approach would be to take a look at the decreasing expenses by 2% while keeping revenues flat. Now, say 50% bump in pre-tax. If your employees can help you increase pre-tax by 50%, this is not to say that your share price is going to go by 50%, but this will translate into certainly a substantial bump in the share price. And a study done recently, ESOP companies pay less for worker compensation. There's a client of mine out in Ennis, Texas, a firm called Polyguard Products. And I put the ESOP in 20 years ago. I was in the area about a year and a half later, and I went down to talk to the owner of the company. I asked John Muncaster how the ESOP was worked from the employee's perspective, and he said it's interesting. He said a month ago, an employee came out of the factory and said that he just hurt himself. He's going to go to the doctor, but he said he really hurt himself, and he may have to take worker compensation. So the main owner told me, I said, I'm sorry it happened, we'll take care of the paperwork. Then a week later, a second employee came in and said, Mr. Muncaster, this is awkward, but the guy that came in here last week that hurt himself in the plant, he hurt himself playing basketball last weekend. So my question to you is, what would motivate that second employee to blow the whistle on the first employee? A, it was the honest thing to do, but B, the second employee was offended that the first employee was going to phony up a worker comp claim that was going to cost the company extra insurance premium and worker compensation claims. So there could be some healthy peer pressure, I think, here. This slide just makes the point about better for the employees, better for the direct shareholders. Okay, let's, communication is key. A lot of our clients will put employee ownership on their logo or in their website. In fact, a lot of our clients have in their website an owner's column, if you will, and they can talk about the history of the company, and they can talk about the ESOP and the role the ESOPs play in the company's evolution. Wisconsin, you've got the 3 flags in the parking lot, American flag, state of Wisconsin, and the ESOP. Maybe you've got the Green Bay flag, and the ESOP would be the 4th flag. Okay, and the other company that's a really great in-depth case study would be this Great Game of Business by Jack Stack, and it's written by the president of the company, Springfield Manufacturing, that's been very successful over the years, innovating ways to drive the ESOP concept down into the rank and file so the employees understand what they have and respond well to it. So let's jump ahead here. I'm going to jump fast ahead. So there really are two other uses of an ESOP for successful private companies. The ESOP can be used as a way to bring cash into the company as capital, or it can be used to help a company with acquisitions. In both cases, it can add more value than the ownership percent results. But the fourth, and this is the one that is really tied to John's point from this morning or from earlier this afternoon, is that ESOP is a way to perpetuate the company as a successful private company. And this is the slide that shows the attrition rate, the failure rate of privately held companies. Over a full 60% of companies don't make it into the next generation. And then less than 60% of that group make it to the 3rd generation, and far less than 60% make it down to the, far less than 60% make it down to the 4th. So if the ESOP is a way to perpetuate successful companies like AFCO Industries or like Meyer, LaCroix, Hickson, then more and more companies will hopefully survive as 2nd generation companies, which retains the jobs locally and hopefully stimulates jobs as well. Not just saves jobs, but stimulates jobs. Okay, so this just tries to focus on what's the ESOP with respect to the key employee accounts and the seller's family account, and is ESOP's going to be a big enough benefit for the key employees to make sure. And this busy slide basically says that about 50% of ESOP, after about a 10-year period, in this particular example, key employees would have about 50% of ESOP. And is that going to be enough to really attract and retain and motivate the key employees? And you can always put together, outside of ESOP, a key employee plan. Here the board of directors decides who's in and who's out, whereas with an ESOP, it's pretty much all across the board for those that have been there 12 months and work 1,000 hours or more per year. Okay, so why an outside key employee non-qualified plan? To increase benefits above the ESOP allocation benefits. How about if you hire an executive after the ESOP's already been in place for several years? So a lot of the ESOP stock's already been allocated, so we have to look to outside stock as a motivation for key employees. All right, now there are 2 families of non-qualified plans. There's the phantom stock, which are basically cash plans where paid in cash bonuses to employees, and then you've got these plans that actually end up with stock to the private key employee. And both have pros and cons, but the point is that the ESOP is flexible to accommodate either one. And just to wrap up, but I think we're about there, as a succession plan or business transition plan, sell company stock to ESOP, you could sell stock to key employees, you could bonus key employee stock outside of ESOP. You could gift stock. How about if you have your favorite college or university? You could gift some of your private company stock to the university. Now, the university doesn't want privately held company stock. They want assets to generate current income. So the charity or the foundation or the university foundation would then sell your private company stock into your private company ESOP. So even if the shareholder donates private stock to the foundation, it's still an ESOP because ESOP's buying stock from the foundation using pre-tax dollars of the company and allowing the employees of your firm to earn into an equity stake. Or you could always, of course, gift some stock to family. Family retains the stock indefinitely. We say ESOP is inherently the least stressful means of transferring ownership. Least stressful means of transferring ownership. So the whole idea is to provide a cash out tool for shareholders that puts minimal pressure on the company financially. So we have the highest probability the company will survive the transition. And pre-tax deductible dollars, ESOP share vest earnings tax-free if it's an S-Corp ESOP, done in stages, less leverage. That's the AFCO. I mean, AFCO, all around the country, when I talked at my seminar, I mentioned AFCO as an example of this multi-stage, phased-in approach that takes pressure off the company doing all of it at once and hoping that it all works out. No change of management control. Okay, so ESOP provides the board with an ownership succession tool and perpetuation tool to perpetuate the company as an independent company locally owned. Now, at the same time, the board has the flexibility to sell to a third party. So nothing about ESOP burns that bridge. And we do lose occasionally some clients that have, maybe they've been in ESOP for 15 years or 20 years and they get an offer they can't refuse and they end up selling out. The employees get a windfall and the direct shareholders potentially get a windfall also. Well, Gary, I think it's 4 o'clock or close to it. You want to, should we do a wrap on this? I mean, we're about halfway through, but I think I hit the 4 primary uses of ESOP, which is really my goal in this shortened time period.
Any questions from these two guys?
Yeah. I see.
One of them already, I'm pretty close to one sell, and it's a smaller company, it's got about 10 employees. I mean, I'm just curious, what makes it a dollar figure?
Well, is it a C corporation or an S corporation? It's an S corporation. Well, you're kind of at that starting point for S corporations because we usually like to see at least 10 full-time employees. Yeah. Are there any family, do you have family active in that company? So all 10 employees are non-family. Are there any family relationships among the 10 employees? Are there family relationships? Yeah, so I mean, that would be on the smaller end, certainly, but that would be something to possibly look at. It is different every time. So it's about $70,000 start to finish. And it starts off, it's about $10,000 to have the company appraised to see if the ESOP idea conceptually is attractive. We're still kind of swimming in the abstract. We need to kind of put some hard math on this to see if it's attractive to you. So typically about $10,000 is the fee to have an appraisal done for sell-side purposes, for your purpose. And then if you don't like the number or don't like ESOP for some other reason, then you pay the 10 grand, that's as far as you go. But then if you do decide to put the ESOP in, it's about $60,000, and that would be, there's a whole list of things that we do for the 60. And that's deductible to the corporation. So maybe if it costs 70 pre-tax, maybe it's 45,000 after tax, after factoring in tax benefit to the corporation. So ordinarily, you'd probably want to have the company be putting in at least, say, $75,000 a year as a company contribution in order to get a deduction on that big enough to pay the costs. Something like that, pretty close.
So, 10 to 15 employees, you can still do this.
Right, they need to be viable, viable companies, either debt-free or modestly levered. And there should be some clear leadership in the company. We've got proven leaders that have already time-tested. But there's, 10 is kind of on the edge, really. Yeah, exactly.
But a company with 100 employees,
Yeah.
we have a lot of those in our organization.
Well, that's right down our wheelhouse. I said the median size of our clients by ESOP ownership percent is about 45% of the total outstanding stock. And the median size, as far as full-time employees in the ESOP, about 80. So 80 is, and let me just think now. Yeah, I'm doing an ESOP in a firm near Hays, Kansas now. It's a manufacturing company. They've got about 130 employees. Then I'm doing a ESOP in an engineering firm over in Knoxville with only about 16 employees. But I'd say 2/3 of our clients have between 50 employees and 250 employees. So 100 would be right down the middle. Well, thank you for listening in for the hour and a half.